Phani Sekhar, Fund Manager of PMS at Angel Broking, joins us right now on the show. Phani, good having you. Thanks so much for joining in. A stock in focus today, Phani. Bajaj Auto, 3% of an up move after the results that came out and pretty much in line. What's your sense? What did you make of the numbers? And more importantly, a couple of issues that they seem to have resolved pertaining to Sri Lanka and even the domestic issues.
That's right. See, this quarter's numbers were expected to be weak. So it sort of puzzled me as to why the stock was selling off 1 week into the results, as if, the market came to know just now that the numbers are going to be weak on the basis of both exports and the subdued domestic motorcycle industry in India. So because both these factors were very well known for over 2 months now. As far as the numbers are concerned, the top line was in line with estimates, but they have done marginally better on the bottom line front. But what really comes as a surprise is that they have ensured that even in this relatively weak export and domestic industry scenario, the margins have not weakened as much as the street would have expected. So on the whole, I would see it as a positive result, especially when the management half of this year is expected to be better than the first half.
Phani, what about views in Reliance Industries, which is slated to come out with its earnings on Friday? Does it seem like it's going to be yet another disappointing quarter?
Well, to begin with, I don't see how many people have any expectations out of that stock. So to that extent, I think the extent of disappointment will be lower. Because, as opposed to maybe 1 year back when one was hoping that the KGD6 production will be going up, now it is fairly well known that production has plateaued anywhere between 25 to 30, and it's not expected to go up in a hurry. Now it's just a function of what's happening both to the petrochemical and the refining side, and there again the markets have softened. So I would see that the company would turn up another subdued set of results. I would not call it a disappointment because expectations were not there to begin with, and the stock price more or less reflects that. So I would not see the stock either moving up or down materially. By materially, I mean more than 3% in response to the results.
Phani, what about the weakness, the perceptible weakness that we've seen in the IT stocks the last couple of sessions? I mean, Infi did its bid, TCS was doing its bid till yesterday, some stability today. The question mark really is, what do you do with IT if you have them in your portfolio? Get out of them or selectively hold on to maybe a TCS or an HCL Tech?
Well, this is not certainly the time to get out of them. TCS and Infi have been behaving very differently for reasons that we know. TCS more or less reflects a profit booking, whereas Infi from time to time it actually shows the nervousness of the investors as to how low the stock can go. Although I believe that around these 21-2200 levels, the stock is very attractively valued, even if it continues with this lackluster performance for a couple of quarters. This is assuming that they get their act together in another 2 to 3 quarters from now. If you have them in your portfolio, this is a good time to keep them. And in cases like Infosys, on days of deep decline, it's also a good idea to keep accumulating them. For the simple reason that over a period of time, over the next 4 to 6 quarters, for a blue chip like Infosys, you have to give them the chance that they get their act together. So that as and when things improve, as the stock is very attractively valued at around 13 times, you can actually reap very good rewards. Assuming that things don't improve as much as investors expect them to, there is always a rupee windfall that is mostly undiscounted at this point in time, and that opens up a window for either a special dividend, some corporate action like a special dividend, or a buyback, which always seems to be on the card, and the pressure of which is also growing on many of these companies. So an investor doesn't lose much by holding on to these stocks or buying them on deeper declines from here.
Phani, what about the defensive pocket, in particular pharma, because that has been seeing a whole lot of traction, as is the case with FMCG too. Would it be sensible in uncertain times like these to stay put into the defensive names?
Well, of course, because as opposed to FMCG, one thing going in favor of pharma, if you talk about the big 3 or 4, that is Cipla, Ranbaxy, DRL and Sun, is that the next 18 to 24 months are going to be very good as far as growth is concerned. So many of these names will turn in growth in excess of 20%. And that's actually a growth number for a defensive stock. So even though valuations in some cases like Sun Pharma look stretched, but I don't see how they will correct only because of valuations, because growth will follow. On the balance, I feel stocks like a Ranbaxy, Cipla or Dr. Reddy's might be good investments even at this point in time.
Phani, what did you make of the weakness that we saw in the Adani Group stocks, particularly Adani Enterprises yesterday? I mean, there are a lot of rumors as well which were unfounded, but the release of the balance sheet as well, which probably displays some weakness or some chinks in the armor there. What do you make of it? Adani Enterprises, possibly even Adani Power, if you track them.
I don't track them, very closely, so can't really comment on them.
Okay. Having said that, those stocks have done reasonably okay for themselves. A couple of others. Phani, there is some strength seen in the retail counters, and there's a lot of talk about how some reforms, maybe not respect to retail in particular, but some reform measures would take place over the next 2 or 3 weeks after the presidential election is out of the way. What's your sense there? I mean, there's a lot of talk on the groups as well about how FDI in aviation might come about in a couple of weeks. Are you sensing something like that in your conversations? Are you taking positions based on that?
FDI in aviation seems much easier than retail. However, FDI in retail also cannot be ruled out, considering the fact that there is some kind of a newfound energy in New Delhi, and I hope this continues. However, taking a position in aviation, at least from a trading point of view, might be much easier than retail, because retail, it is also contingent on how many states allow it, and if FDI in retail comes, it's going to come through an executive fiat, which means that they will leave it open to states to embrace that. Now, it might be argued that over a 3-year time frame, a large number of major states would embrace that. But, in the next 12 months or 24 months, you would selectively see 4, 5, 6 and 7 states welcoming FDI in retail, which means that from a corporate point of view, it might not make a great sense for any of the existing corporate entities to, that is the retail entities, to dilute themselves. And also they might not get the kind of premium valuation that they would be requiring from their overseas partners, considering the fact that they cannot roll out the entire retail structure with the FDI in it across the country, and they can only roll out this FDI with their FDI partner in some states. So considering that, I guess that there might be a tepid response, at least in the rollout phase. So that would actually cap the returns that many of the investors might be expecting.
Right.